Ask a Filipino what his or her favorite fast food chain is, and without any hesitation, he or she will avidly say, Jollibee. Over the years, Pinoy's fond for this food place have been consistent. Perhaps Filipinos can truly testify Jollibee is a place where bida ang saya. So, how did Jollibee become a drum in propagating Filipino pride around the globe and became one of the most successful Filipino multinational chain of fast food restaurants? Well, Jollibee Food Corporation first started when Tony Tan Kakchiong opened Magnolia Ice Cream Parlor in 1975, which would later be the first Jollibee outlet. By 1978, it became fully incorporated as a full Filipino-owned corporation with a total of 7 branches established. It was finally put on the top 1,000 corporations of the Philippines in 1981 with famous products such as the Yum Burger, Spaghetti Special, and Chicken Joy already in the menu, surpassing its competitors in the fast food industry by dominating the market and taking the lead in 1985.
By 1987, it finally stepped its weight into the global market by opening its first international branch in Brunei. Today, Jollibee is one of the largest fast food chains in the Philippines, operating a nationwide network of over 750 stores. It is the leading fast food chain which owns 50% market share. From the year 2000 onwards, they have acquired many other fast food companies to add to their already successful franchise, such as Chowking, Greenwich, Red Ribbon, and more. In terms of its international presence, Jollibee is now present in China, Hong Kong, Indonesia, Saudi Arabia, the United Arab Emirates, the United States, and Vietnam in addition to Brunei. This was followed by becoming the only Philippine company that was ranked as the 60th of Asia's Best Employers list. In addition, it was also ranked third as Asia's Most Admired Companies in 2000.
Jollibee has no plans of ceasing its growth with the goal of doubling their numbers of their restaurants worldwide, which means a total of 4,000 outlets by the year 2020. JFC Corporation also recently acquired global brands like Hard Rock Cafe, Smash Burger, and Pho24. Recently, JFC brought back CBTL or Coffee Bean and Tea Leaf to New York. CBLT was recently acquired by JFC this September of 2019 for roughly $350 million, affirming their commitment to grow its restaurant business in US, which is its biggest overseas acquisition so far. So it seems JFC is on a saga of aggressive expansion and diversification of their business portfolio.
So let us now move on to the computation of the financial ratios of Jollibee Foods Corporation. So we will be talking about two liquidity ratios, which are current ratio and quick ratio. As for me, I will be only talking about current ratio. So the formula for current ratio is current assets and divided by current liabilities. So for 2015, for the Jollibee Foods Corporation, their current ratio is 27,169,000 divided by 21,068,000 is equals to 1.29. For 2016, it is 30,369,000 divided by 23,831,000 is equals to 1.27. For 2017, it is 37,329,000 divided by 26,947,000 is equals to 1.39. For 2018, it is 42,738,000 divided by 34,185,000 is equals to 1.25. And lastly, for 2019, it is 45,628,000 divided by 62,030,000 equals to 0.74. So for quick ratio,
So for quick ratio, the formula is quick asset divided by the current liability. And for the formula of quick asset is current asset minus inventory. Next is so for the quick ratio of 2015 is 19,469,000 divided by the current liabilities of 21,068,000 is equal to 0.92. For 2016, is equal to 23,103,000 divided by 23,831,000 is equal to 0.97. So for 2017, 29,076,000 divided by 26,947,000 is equal to 1.08. For 2018, 32,372,000 divided by 34,185,000 is equal to 0.95. And for 2019, 33,613,000 divided by 62,030,000 is equal to 0.54.
Okay, so now as you can see here, this is the summary of the computation for liquidity ratios, specifically the current ratio and the quick ratio. So next, please. Lastly, let's talk about the interpretation we can draw out from the values of current ratio and quick ratio. Jollibee Food Corporation's stable current ratio from 2015 to 2018 used to imply that it had the capacity to pay off its short-term debt with the current assets it owns. However, the sudden decline in its current ratio for 2019, bringing it effectively lower than 1, is a big cause for concern for both management and investors, as this signals the corporation's inability to address its current liabilities. Furthermore, we can also see a similar theme in the corporation's quick ratio. While 2015 to 2018 quick ratios were mostly below 1, it was still acceptable given the inventory-intensive nature of the corporation's industry. The 2019 quick ratio, however, is concerning mainly because it is so far from 1 and thus reflects the increasing reliance of the corporation with its inventory to address its current liabilities. So that is all. Thank you.
Hello, good morning, ma'am. Good evening, and good afternoon, ma'am. Analysis. I but before that, let me introduce myself. I am Adrian J. Kajendre, Group One. Um, uh, will be presenting the interpretation. So analysis. Quick ratio. It indicates a company capacity to pay its current liabilities. A good quick ratio is any number greater than 1. So in 2015, Jollibee had a quick ratio of 0.92. Also in 2016 and 2018, it had a quick ratio of 0.97 and 0.95, which means it may not be able to fully pay off its current liabilities in the short term. In 2017, it had a comeback ratio of 1.08, which means it has a sufficient liquid assets to meet its short-term financial obligations. But in 2019, ratio declines 0.54, which means it's below 1. This means that the year 2019 for Jollibee had more current liabilities than its assets, which we believe it is an indicator for financial distress. So this, as you can see, this is the line graph for quick ratio. As you can see, 2019 plummeted down, so which means it has financial distress. And as you can see, 2017, uh, it um, uh, Jollibee uh, had a enough current asset to pay its current liabilities. So only the graph provided above presents that quick ratio of JFC over the past 5 years. At 2015, the quick ratio of Jollibee plummeted due to their acquisition of an American fast food chain named Smash Burgers to boost their presence in the American market. This decreased JFC's current asset as much of it it was allocated for the stake in the latter. However, after a year, Jollibee was able to bounce back, which may generally be credited to the temporary boost of their newest addition. On the preceding years, we could see that gradual decrease as JFC continues to acquire bigger stakes toward the American fast food company.
So, in continuation to the liquidity ratios, let us now discuss on the current ratio. So, it is the ratio which measures the ability of the company to repay the short-term debts which are due within the period of the next 1 year, and it is calculated by dividing the total current assets of the company with its total current liabilities. Here we have the significant data in computing for the current ratio. We will need both the current asset and current liabilities. Now, notice that we included the receivables and inventories in the table. This is because the current ratio is not a solid basis of liquidity. We have to remember that there are certain limitations to this ratio. First is that receivables must be collected first and converted to cash. Second, inventories must be sold and turned into cash because you cannot pay off obligations using receivables and inventory. We need hard cash. Thus, how much our receivables and inventories take up the whole current asset is important to take note of. Next is we have the basis for the current ratio. So first is if current assets is greater than the current liabilities, ratio is greater than 1, which is a desirable situation to be in. Second, if current assets is equal to the current liabilities, ratio is equal to 1. Thus, current assets are just enough to pay down the short-term obligations. Lastly, if current assets is less than the current liabilities, ratio is less than 1, which is considered as a problematic situation at hand as the company does not have enough to pay for short-term obligations.
So hello everyone. And to conclude, let's answer the 4 questions. So number 1, is the company Jollibee Foods Corporation liquid? Now, based on the general rule of interpretation that a current ratio must be higher than 1 in order to be desirable, we can say that Jollibee Foods Corporation is indeed liquid and able to satisfy their short-term debts along with their short-term assets for the last 4 years from 2014 to 2018, but experiences a sudden decline in 2019. Hence, we must also consider what are the things that make up the current assets, which are the cash and cash equivalents, trade receivables, and inventory. It must be sold first and converted into cash. Same goes for the inventory. It must be sold first and converted into hard cash to pay off their short-term debts or obligations. Now, in the case provided, we can see that both the receivables and inventory is higher than the cash and cash equivalents, which is a good indicator of liquidity. Question number 2. Do they manage their assets well? In a deeper analysis, the slight decrease in receivables in the last 3 years and the substantial increase in ending inventories alongside the gradual increase in current ratio might indicate that the corporation is becoming less liquid. So, because of the assumption that there was an increase in cash collection. Now, on the other hand, looking into the inventories in the past 5 years, we may notice an increase which indicates that despite the increase in the current ratio, this may not be substantial proof that the corporation is becoming more liquid every year, but enough to say that they are just liquid. The analysis on the decreases and increases on receivables, inventories, and cash is a good indication on how they handle their assets. Question number 3. Are they risky? Now, we are also able to conclude that the company may be at risk in paying their short-term obligations based on the ratio, but not on high impacts. However, we would also like to inform potential investors to exercise caution, as we have yet to see JFC's or Jollibee Food Corporation's next actions, which may cause the ratio to decrease. Question number 4. Would you invest in that company? Would you invest in Jollibee Foods Corporation? Looking at JFC's current status on its liquidity ratios, it is beneficial to invest in that company if the investors would go or is looking to go long term. This is mainly attributed to the fact that JFC is still establishing a better foothold outside the Philippines. JFC's liquidity ratios may be subpar compared to industry partners, but it should be taken into consideration that they are expanding, which would sacrifice a portion of their liquidity, but not to such extent. We expect the company to be safe bet towards going long term given their current actions. Furthermore, it is very unlikely for the company to plummet the bankruptcy as they are liquid and has the capacity to meet their short-term obligations.